So I think everybody has heard the story on Facebook recently. They posted earnings. It was a slight miss and a pretty bad forecast. Not a bad forecast, just not what people were expecting. And it led to the largest single day loss in value of any company ever. They lost like $200 billion in market cap in one day. Insane. I mean, here's the chart. You can look at it. Down 20%, and it hasn't really recovered over the last 2 days since then. Sometimes if a company posts an earnings miss, it'll snap back the next day, and that's why I always say earnings misses are sometimes the best times to buy stocks. It's the best buying opportunities. That still might be the case here. So if you remember, I did a video on Facebook back in November, so let me pull up a 6-month chart. So yeah, look here. I did it, I think, around November 20th, and it was 340 or so at the time. And I remember saying, look, I like this stock. I didn't like it as much as Google at the time. I thought Google was a little closer to fair value. But Facebook and Google, I think, are the only two out of the FANG stocks that I would have considered buying at that time. Since then, I mean, Google fell all the way to 2,500. I'm kicking myself for not buying that. I almost did, and then I didn't pull the trigger. And then Netflix had the big tumble, and I did a video on Netflix too. I haven't done any of the other FANG stocks yet. So in an effort to not make the same mistake twice like I did with Google, where I didn't capitalize on the dip, I'm going to be doing a deeper dive into Facebook, kind of a review of what we found, and then point out some more key metrics, look over their earnings presentation, their earnings call, and see if we can get an updated valuation that's a little more on the conservative side. So let's get started. First, we're going to look at their earnings presentation that they just released. Alright, so here is Meta's earning presentation. I know I've been calling them Facebook this whole time. I guess the company formerly known as Facebook, Meta. Okay, so there are a couple things I want to point out here. Remember, whenever we look at earnings presentations, I always like to look at what metrics the company is using, because that gives such a great insight into how management thinks, what they think is important. If they're highlighting something as important that they're judging themselves on, that should be something that you're watching as an investor. So first up is advertising revenue, and of course, I mean, that is what Facebook does. They sell our information to advertisers to make more money, right? All right, and then we're gonna skip over this because I want to show you what's really neat. Is this? These are all financials. You can see it's like their expenses, their tax rate, their net income. But what's interesting is whenever they get to here, okay, the DAP and the MAP, DAP and MAP, the daily active people and monthly active people. So these are the two metrics that show how many people use Facebook or one of their apps on a daily basis, and then how many use it on a monthly basis. Really interesting. I think the slower growth has kind of scared some people. I mean, you can see it's starting to plateau here. Same with the monthly users. I am not one of these. I haven't gotten on Facebook in years. But I know they also own, I think, WhatsApp and Instagram. So there's more than just Facebook. All right, so then I want to show you this too. All right, this is by region. So this is what a lot of people are freaking out about. The article titles have been like, Facebook loses users for the first time in the company's history. So what you saw above, these numbers, that's for everything, but Facebook has actually had a decline. So for the first time ever, from quarter 3 2021 to quarter 4 2021, they actually lost, what is this, 1 million subscribers. I mean, 1 million out of 1.9 billion, so it's not like a huge number, but still it's trending in the wrong direction. So that spooked a lot of people, combined with something else that we're going to look at real quick though. Look at this, where is it? Facebook average revenue per user. I thought this was neat. This is how much money they make per person per quarter. So if you want to know what you're worth to Facebook, look at whatever region you're in. So like I would look in the US, and if I was using Facebook, they value me at $60 a quarter. 60 times 4 is $240. So Facebook's making $240 off of you per year if you live in the US. So I just thought that was interesting. All right, let me go to their earnings call and we're gonna highlight some things. I have the transcript here, let me pull it up. Okay, so no matter what, if you're gonna invest in a company, I highly recommend reading the transcript or listening to the earnings call. I think you get so much information from it and it's super important. I'm just gonna highlight a few key things. So Mark Zuckerberg's opening statements, he set the tone right away by saying, there are two things I want to call out that are having an impact on our business. See, he says that right here. Okay, first is competition. People have a lot of choices and they're picking TikTok. That's what he says. He says they're losing market share to TikTok because people are focusing, or people prefer short reels, short videos to what Facebook's old platform was, which was, sharing news articles, having great political, intelligent discourse like everybody sees on their Facebook news feeds. And yeah, so anyway, what they're doing is they're switching their focus to be more reel based, which is going to try to compete with TikTok, try to compete with YouTube Shorts. But as he mentions, there's kind of a struggle with monetizing that. They're trying to figure out how they can squeeze everything out of the reels. One other thing we're going to get from the earnings call is the outlook. So just here, Control F, outlook. This is, okay, Dave Werner, CFO. He said he's going to end with our outlook. Okay, so let me go to the next time he says it. Okay, turning now to the outlook. This is another thing everybody got spooked by. They expect first quarter 2022 total revenue to be in the range of 27 to 29, which represents 3 to 11% year-over-year growth. So they're expecting only 3 to 11% growth in their business. That scared a lot of people. This is a FANG stock. This is a big tech stock. These have been overvalued because they've had such high growth rates, and people think they're going to have such high growth rates in the future. I meant to touch on this a little bit more in the intro section, but let me just show you something real quick. Okay, so this is the valuation page from the original video. I was supposed to talk about this earlier. I skipped it, but let's just go over it real fast. We had a target price of 173 based on our rule of thumb pre-tax method. That one usually grossly undervalues growth companies because there's no growth. Do you see growth in this equation at all? No. So I'm kind of okay with that one being low. This one, the earnings per share and growth formula, is super weighted to growth. See, growth is multiplied by 2 in this equation. If I remember correctly, in that video, I think I had a growth rate of 15% for Facebook in this case, which is much higher than that 3 to 11%. So I think whenever we do our new valuation, we're going to be lower in that growth rate. And likewise, in the DCF one, we had a perpetual growth rate of 10%, which if they're only projecting 3 to 11% growth next quarter, they're not going to perpetually grow at 10, okay? So I think that was also a little too ambitious, but they've had some other things change, and that's going to be what we look at in the financial statement. So let's go ahead and get started there, okay? First up, income statement. I just want to review some of these numbers. Okay, look at their total revenue. For everybody saying this stock is dead or this company's dead or it's only old people, I mean, their revenue is still on an exponential graph. This is insane, okay? This is awesome. That's got to be worth something. Let's look at their margin, because if a company's losing margin, that's kind of a leading indicator that they're starting to lose their edge. They're starting to lose their competitive advantage. They're having to cave a little bit to competitors. So are they losing margin? Not really. 40% operating margin, pretty strong and not shrinking. All right, let me show you what's next. Pre-tax income. Yeah, if the revenue's growing and the margin's steady, the pre-tax income's going to be growing too. And yeah, look at this. Now, recently it has been a little flat. That's interesting because revenue's been growing and margin's been pretty stable. So I find that a little bit interesting. But, you know, this is just crazy how they had such a huge fall off of an earnings miss. And this is what their income has looked like over the last, 11 years, 10 years? This is every quarter going back to 2011. Okay, so let me get a metric here. I'm just going to put $12 billion. Just say that they're going to stay at this line. I think that's actually a little conservative, but that's what I want to do. Okay, so if I put 12 billion for the pre-tax income. All right, and next I need a growth rate. I'm not getting a growth rate from this. I'm going to get a growth rate from what they told me, 3 to 11%. So what is the average of 3 and 11? 7. So 3 plus 11 divided by 2, 7. So I'm just going to use 7%. They said that they're going to grow 3 to 11%. I'm going to split the difference, all right? Now let's go to earnings per share, and I'm just going to take the trailing 12 months. So if I do that, I sum the last 4 quarters, that would be the trailing 12 months. I get $13.80. $13.80 for my earnings per share. Let me write that down over here, $13.80. All right, and then I just want to fly through the balance sheet again real fast and show you some other amazing things with this company, okay? First off, total equity. It's growing a lot. Now, it's shrinking recently, which is a little concerning, but, you know, one thing that you always want to check if total equity is shrinking is, well, maybe they're buying back shares, so their equity per share might not be shrinking. So let me go look at equity per share. I look at that. It's same pattern. So even if they are buying back shares, it's not making a big dent in their equity per shares. But now I'm curious because if somebody's equity is shrinking, that's either their assets are going down or their debt's going up. So let's see. Total assets are going down a little bit or flatline. That's pretty interesting. So I wonder what's caused this huge growth and then just flatline. That'd be something, it's interesting. And then let me look at debt. Now, I'm going to look at debt, but their liabilities, total liabilities are so low, it's a non-issue. So they went from $30 billion recently to $40 billion of total liabilities, but compared to their equity, it's almost nothing. So like, look, if I do their debt to equity ratio, remember I said I usually like this ratio below 2 because that shows like good financial strength. I really like it as low as possible or below 1. Theirs is 0.2 to 0.3. Awesome. A+, very healthy balance sheet, low debt, growing equity, And lastly, I just want to touch on their return on invested capital. Return on invested capital, I know I usually do return on assets, but return on invested capital is neat because it's really similar. I mean, return on assets is all your assets and your income divided by all your assets. Return on invested capital is all your income divided by your debt plus equity. But debt plus equity is usually equal to your assets, so they're pretty much the same thing. The only difference is the return on invested capital does not include all your liabilities, just your interest-bearing liabilities. So it will be a little bit better than return on assets, but they're going to be close to the same number. I'm fine with either one. I know Everything Money, one of their 8 pillars is return on invested capital. To me, I prefer return on assets. I just think it's more intuitive, but they're like the same number. So wouldn't worry about it if you prefer one or the other. Just do whatever one makes sense to you. Okay, so their return on invested capital is insane. 30%. That's awesome. Can you imagine if you had capital and you invested it and you got 30% a year on it? You'd love that. And especially if you did it with growing equity and growing debt, so growing capital. Yeah, 2 thumbs up for that too. All right, lastly, let's run through the cash flow statement real fast. Free cash flow, look at this. Exponential, that is awesome. I'm going to say they're going to stick at this $12 billion free cash flow. Yeah, I'm not going to do that. That's a little too... I'm being a little too optimistic. I'm going to just take the last 2 quarters and multiply by 2 because the last 2 quarters summed would be 1/2 and then multiply that by 2 to get a yearly number. So the last 2 quarters summed together equals 22.5. So $22.5 billion times 2, and I get a estimated free cash flow on a yearly basis of $45 billion. All right, I want to show you something neat here because everybody knows Facebook is buying back shares. I mean, you might not know that, but let me show you their buybacks real quick. So they're spending a boatload of money buying back shares. Where is it? Repurchase capital stock. Okay, look at this. They're spending $20 billion in the most recent quarter. So they spent $20 billion before the stock drop buying back their shares. One thing I'm going to be watching if I invest in this, even if I don't invest in this, if they bought back shares before this big drop and they were spending a lot of money doing that, they better be buying it back now, and they better be buying it back with a fury, right? Because if management is rational, which I hope they are to have such a successful company like this, if they're rational, they will buy back shares whenever it's the best thing to do with their cash. Now they're getting 30% return on invested capital, so that's capital invested into their own business. So you would hope that they would only be buying back their stock if they thought it was at a huge discount to intrinsic value. I mean, it has to be pretty discounted to turn down 30% return on invested capital. And I worry that that might not be the case. I worry that they might have just been buying it back to keep it propped up. I don't know. I'm a little nervous about that, and let me show you one other thing that makes me think that too, is that in their operating cash flow, they actually paid for a lot of things with stock. So their operating cash flow, their cash brought in from operations was $18 billion. So operating cash flow is going to be pretty close to your income, or it's going to be pretty close to your income if you subtract out depreciation. But let's say then that you used your stock to pay for things or pay employees. What that does is that's stuff that you have to book on the income statement because you actually, use stock to do something, but you didn't actually spend cash. So if you didn't spend cash, it's not going to be taken out of your cash flow statement. I don't know if that makes sense, but basically they used $2.5 billion in stock-based compensation. So they're like selling the stock here or spending their stock over here instead of cash, but then they're also buying it back. It just seems like kind of two competing philosophies. I know that this is on a much smaller scale, like 2.5 billion versus 20 billion that they were spending buying back stock. But just take a look at this one more time, okay? I'm going to pull it up. They were repurchasing stock they started heavily repurchasing stock in Q2 of 2021. So I'm going to pull up the stock price again. Let me pull it up. So Q2 2021 would be like here, around this area. So they were buying it around $300 a share, and they bought more and more, and they bought more again in the most recent quarter. So they were buying it around $300 a share. Okay, now they're going to get the opportunity to buy it at a big discount to that. Like I said, they better be doing that, okay? That's all I got to say about that. Okay, let me go to my new valuation. Okay, so the first one, rule of thumb method, pre-tax income times 10 divided by the number of shares. So 12 times 10 divided by 2.78, 43. Okay, hold up. What's going on here? 12. Oh, I did the 12 billion is their quarterly number, so I had to multiply 12 by 4. Let me fix that per quarter. Okay, so let me redo that. Okay, 12 billion times 4 times 10 divided by the number of shares, which is 2.78. Okay, same value, $173 a share. We expect that one to come in lower for growth tech companies, but I still like to do it just to be consistent. Next one, earnings per share times all that stuff. Okay, so earnings per share, 1380 times 8.5 plus 2 times your growth rate, which we said was 7. All right, so $311, right on, that's higher. And then lastly, our DCF. Let me put in our free cash flow estimate, which was $45 billion. Our perpetual growth rate, I'm going to say 7%. And discount rate, I discount at 15%. And I get a net present value of $646 billion for the market cap. So 646 divided by 2.78, $232 a share. All right, that one is really close, and I like the discounted cash flow the best. I think the pre-tax one usually comes in low, and the earnings per share one usually comes in high. So combined, I really feel comfortable with this one. All right, average price target is now $240 a share, so right almost what the share price is. I did the same exercise for Google after it had fallen, and it was right near my target share price. It was actually lower than my share price target, and I didn't buy it. And it immediately spiked back up, and I regretted my decision. I was like, man, you had the formula. It went below. That was the time to strike. And I don't know what I'm going to do here. I'm definitely going to watch it. I'm not jumping to buy it right now. There are a couple things I want to see. Really, there's one thing I want to see. If it comes out in Q1 2022 that they bought back even more shares, that's going to make me feel very confident with management. If it doesn't, I would be extremely disappointed, because to me, that's just being completely irrational, and I don't want to invest with management that's irrational. That's just my opinion. Also, if it fell below 200, I think I would buy it immediately. Something similar happened to Intel, where I said I wasn't going to buy it at like 55, and then it dropped to 47, and I was like, well, now I'll buy it. But the same thing with Facebook. If it goes sub 200, I think it's an automatic buy for me, but that's just my opinion. And I know there are some risks as far as, losing competition to TikTok, having to shift their business platform. Some people think that this whole Meta thing is them realizing, oh man, our Facebook business is dead. Our social media stuff is dead. We got to pivot, or else we're going to just flounder. I think based on looking at the financials, that is not the case. I mean, do I need to pull up the revenue growth again? But at the same time, like I said, there is some risk. And that's kind of why I put that quote up there. You're never going to find an investment with zero risk. There's always going to be some risk, and your job is to find out what risk you think is viewed wrongly by the market and what risk you're willing to accept as a shareholder. So that's all I got. If you learned something, if you enjoyed the video, like and subscribe, check out more on my channel. I'll see you next time.